Builders are pulling back, but buyers aren't. For months, Americans have been waiting for the housing market to get easier, waiting for rates to come down, waiting for more inventory, waiting for affordability to improve. But this week, the housing market delivered a surprising message. Builders are slowing down, at the exact same time as buyers are coming back. And if those two trends continue, the next move in the housing market may not be what most people expected. So let's break it down. This week marked Kevin Warsh's first Federal Reserve meeting as the Fed chair. And while many investors were looking for clues about the future of interest rates, the Fed chose to stay put. The federal funds rate remained unchanged between 3.5% and 3.75%. This was the fourth consecutive meeting without a rate change. Now it's important to remember the Fed doesn't directly set mortgage rates, but it does influence borrowing costs throughout the economy. And markets, they pay close attention to what the Fed says. During the meeting, Warsh emphasized the Fed's commitment to restoring price stability and getting inflation back towards its long-term objective. He also announced several initiatives designed to improve how the Fed evaluates data and communicates with the public. But while the Fed grabbed the headlines, the housing market may have delivered the biggest story. Builders hit the brakes. Let's start with new home construction. Housing starts, which measures new home breaking ground, fell 15.4% from April to May. That's a significant decline. In fact, new construction activity dropped to an annualized pace of just 1.18 million homes, the lowest level we've seen in several years. Building permits also slipped slightly, and builder confidence remained weak. The National Association of Home Builders Housing Market Index fell to 35. Anything below 50 means more builders view conditions as poor than good. Why? The reasons probably sound familiar. Affordability challenges, elevated mortgage rates, and higher construction costs. Builders remain cautious. And that matters because new inventory takes time to reach the market. Homes have to be permitted, built, completed, and sold, which means today's slowdown could affect the future supply. But here's where the story gets interesting. While builders were becoming more cautious, buyers were becoming more active. Pending home sales rose 3.8% in May. That marks the fourth consecutive monthly increase. And the pending home sales index, it climbed to 76.8, the highest level we've seen since 2025. Think about that for a moment. Mortgage rates spent much of the month between 6.4 and 6.7%, yet buyers kept signing contracts. Sales were also up nearly 5% compared to a year ago, and gains were also reported across all four major regions of the country. That's not what many people expected. So why are buyers coming back? This may be the most important question from this week's report. If rates remain elevated, why are buyers returning? According to Lawrence Yun, chief economist for the National Association of Realtors, we may be seeing what he calls a late spring buyer's rush. In other words, there appears to be significant pent-up demand in the market, and many consumers may be accepting mortgage rates above 6% as the new normal. That's a major shift in mindset, because for the last few years, many buyers have been waiting. They've been waiting for rates, they've been waiting for prices, they've been waiting for certainty. But life doesn't always wait. Families grow, people relocate, jobs change, and housing needs continue regardless of where rates happen to be. The economy still remains resilient. The broader economy also showed signs of strength this week. Retail sales increased 0.9% in May. That was well above expectations, even after excluding gasoline purchases. Consumer spending remained stronger than economists anticipated. At the same time, new unemployment claims remained relatively low. However, continuing unemployment claims stayed elevated at 1.81 million, suggesting that some workers are taking longer to find new employment. So the economic picture remains mixed. Stronger consumer spending, a labor market that's slowing, and a housing market that continues to surprise people. The big takeaway, the biggest lesson from this week's data isn't that the Fed held rates steady, and it isn't that construction slowed. It's that housing demand continues to show resilience. Builders are pulling back, buyers are stepping forward, and that's creating one of the most important stories in today's housing market. Because if demand remains stronger than expected, while new supply remains limited, competition for available homes could stay elevated. And that's something every buyer should be paying attention to. Here in Hampton Roads, inventory continues to vary by market. Chesapeake currently has 759 active listings. Virginia Beach has more than 1,100 active listings. Norfolk remains just under 700, and Suffolk sits around 580 active listings. Median home prices have remained relatively stable across the region, giving both buyers and sellers a market that's moving, but not dramatically. The housing market has a way of surprising people. And this week was another reminder. Just when many expected buyers to stay on the sidelines, contract activity increased for a fourth straight month. At the same time, builders came in more cautious. We'll continue watching these trends closely. If you're thinking about buying a home, refinancing, or simply trying to understand your options, I'm always here to help. And if you enjoy market updates that explain what the headlines actually mean for everyday homebuyers, make sure you subscribe. Because next week's report on inflation, GDP, jobless claims, and new home sales could tell us even more about where mortgage rates and housing are headed next.